You've probably heard about the importance of cutting your costs and saving more in your journey towards financial independence. But one piece that is not to be forgotten is about the importance of investing. Savings alone is not going to get you there easily. And to illustrate that, we're going to take a quick look at a simple example. Let's say you start saving and stashing away some money and putting it in a bank account. You start off by putting aside $1,000 per month. For the most part, as you may be aware, in many of the developed countries, the typical interest rates are quite low. In most cases, are below 1% and sometimes barely even getting to 0.5%. Now, during the inflation times, things have changed. Right now, the interest rate for some banks are slightly higher. In this example, we're going to put around that 2% interest rate. As indicated, this is usually one of the highest levels that we've seen it. For the most part, these interest rates are barely about 0.5%. But let's assume you get 2% in interest rate. And this is by putting your money in the bank. Assuming that your interests are compounded yearly, which typically is the case, and you continue to put away that money and save it for 30 years, after 30 years, your money is going to grow to about $491,000. It's a massive chunk of money set aside, and it's interesting that about 131,000 of it is in fact gained as an interest. It is actually a nice earnings, which goes to show you how the importance of compounding really plays a part. Over time, your interest is going to grow, and your interests are going to also earn interest on its own as well. Now, the case might be very different if you actually decided to invest your money. For the most part, typically for the stock market, on average, you can expect a 7% return. Now, there are years that the stock market does better. There are years that it does worse, but over the long enough span of time, in this case, we're looking at a 30-year time frame, this is a very reasonable average that you can expect investing in the stock market. And you're going to be diving into some of those examples of how you can gain that, but let's follow up with this example first. The thing is, if you notice, for that same period of time, if you put your money into an investment avenue such as stock market, you would be growing that money to about $1.1 million. Quite an extensive increase compared to having it aside, perhaps just into a bank account and expecting such a low interest rate there. In this example, the amount of interest you're earning is actually massive. Close to $800,000 of this amount is indeed your interest. You can see how it's just dominating the total amount that you have here by earning it through the interest and through the power of compounding. Now, you might be asking, all right, you've intrigued me and I'm interested to start investing rather than putting my money just into a simple bank account that is barely going to give me much of interest. How can I go about it? I don't know much about investing in the stock market. I don't have time to do research, do the stock picking. I hear about diversification, but I'm not as familiar with it. Well, not to worry. And in this video, we're going to be sharing with you three options, three different exchange traded funds for investors in Canada that they can take advantage of. These are considered to be totally passive investment options, but slightly higher of a risk. And I mentioned what I have in mind by that. The fact of the matter is these three picks are giving you 100% exposure to stocks. And as you know, stocks tend to be typically higher in terms of volatility, but also higher risk and comes with higher rewards. There are other alternatives similar to these ones, but slightly different, whereby rather than getting 100% exposure to stocks, you could get, for instance, 80% exposure to stocks, and the other 20% is exposure to bonds or fixed income. And there are also the other types whereby it's almost 50% exposure to stocks, 50% exposure to bonds. And for those who are getting closer to their retirement years, you might want to then switch potentially to much more exposure to fixed income and bonds and less exposure to stocks. Those are different options for you to consider. In this case, we believe that for someone who has long enough of a time horizon, let's say 30 years, these could be perfect options because you're maximizing your gains by getting 100% exposure to stocks. These three picks for us to look into and kind of compare them head to head are VEQT or Vanguard All Equity ETF portfolio, XEQT, which is iShares Core Equity ETF portfolio, and HGRO or Horizon Growth Tri ETF portfolio. These are different three companies from Vanguard, BlackRock, and Horizons. And we are going to be comparing them head to head to see how they've performed over the past years and what are ultimately the better choices for investors in here in Canada. In terms of their last closing price for these ETFs, the VEQT was last closed at the price of $31.48. It was up by about 1% for the day. XEQT has a last closing price of $23.30, and it was up by, again, about 1%, whereas HGRO has a closing price of $11.95 and was up by 1.42%. Keep in mind, just because HGRO is lower in terms of its price tag doesn't mean that necessarily it's a better choice. These funds have different valuation, and overall they're all giving you exposure to that 100% of stocks. And as an example, through Vanguard All Equity ETF VEQT, you are investing in one ETF, but by doing so you're already getting an inherent exposure to close to 14,000 different companies throughout the world. Which is why these ETFs, all of the three of them, are wonderful because you don't have to really do stock picking or do any research. It's very perfect way of, very excellent way of getting exposure to passive investing and a very diversified exposure as well. We're going to take a look at it in a moment, but through these ETFs, you're getting exposure to international stocks, US stocks, Canadian stocks, emerging markets, you name it. One consideration when it comes to investing in these ETFs is always about their management expense ratio, known as MER. That's the fee that is deducted by owning these kind of ETFs. The fee is not deducted, very candidly afterwards. In fact, it's hidden in a sense within the ETF itself. So you're not going to see this fee coming off of your stock brokerage accounts, but rather it's deducted from within the performance of the funds. Hence, you're not going to be seeing it, but it's worthwhile for you to know what the fee is, because as we know, fees can really, get out of proportion. And sometimes when investing in mutual funds, as an example, whereby they have fees, MERs of around 2% or so, those are really going to jeopardize your returns over the long span of time. In this case, all of these three choices have quite considerably low fees. For Vanguard, it has the fee of 0.25%, which is the highest among these three. XEQT has a fee of 0.20%, and the HGRO has, in fact, a rate and fee of MER of 0.16%, which is the lowest of all. Just to put things into perspective, what these fees indicate is that, let's say if you had invested $10,000, the fee that is deducted from within the funds without you even seeing it would be $25 for VEQT, $20 for XEQT, and $16 for HGRO. All in all, quite low fees. Let us take a look at their past performance of these funds. But before I do so, I want to share quickly with you when they were actually initiated and what was their inception date. All of these funds have their inception date back in 2019. As you notice, VEQT was started earlier on in January. Then we had XEQT back in August, and then in September of 2019, we had HGRO. In terms of the performance, if you look at the past performance of these funds, let's say for the past 1 year, we are noticing that in the past 1 year, all of these funds have done quite poorly. The VEQT was down by 11.7%, XEQT was down by 12.5%, and HGRO was down the most by close to 18%. VEQT had the least negative performance compared to the rest, done slightly better here in the past 1 year. If you look at the past 3 years, here, it's worthwhile mentioning that for VEQT, you are seeing the overall cumulative return of 17%. For XEQT, you're seeing the overall return of 16.5%, and for HGRO, 17.6%. HGRO slightly did better, but overall, all of the three of them are quite close. Now, we know that because they have been incepted back in 2019, it's not worthwhile for us to look at the past 5 years, but rather let's take a look at their return since a common inception date. That would be the latest inception date that we had, which is for HGRO. Since then, their overall return is very much similar to what we saw earlier on. And if you look at their return since their own respective inception dates. Obviously, VEQT has its inception early on. It's showing a cumulative total return of 26% positive. This is despite the fact that in the past 1 year, VEQT was down quite extensively. This is the beauty of investing in passively in funds, and also investing for a longer term. These short term, let's say 1 year or 2 year downturns in the market is just going to really fade away when you look at it more broadly. Another prime example is during the mid or early 2020, when we had the pandemic. You see all of these funds did poorly, but they really went back on within a reasonably short span of time and really gained a lot. So investors who continue to stay invested and also add to their positions while these funds were doing poorly really reap the benefit of that by having that longer term time horizon and perspective. As I indicated, these funds are getting exposure for you to multi-thousand stocks. In terms of number of holdings are shown a lot less. The reason is that these are consisting of their own respective ETFs. So for example, for VEQT, it consists of a number of other Vanguard ETFs. And through those ETFs, you get exposure to multiple geographies, and you get exposure to multiple stocks and diversifications. That's how it's done. But in reality, you're getting exposure to multi-thousand stocks, so close to 14,000 as an example for VEQT. The other thing we want to take a look at is in terms of their distribution frequency, how frequently they pay those dividend distributions. For VEQT, it's paid on an annual basis, typically in the months of January. For XEQT, it is paid on a quarterly basis. And for HGRO, it does not currently have any distributions. Looking at their holdings that they currently have, you are seeing the top 3 holdings for them. As I indicated, these holdings are their own respective ETFs, other ETFs that forms these all-in-one passive ETF funds for us. And in terms of the sector breakdown of sector exposure, for VEQT, your biggest exposure is to ETFs, of course, mainly then following by financial services, energy, and basic materials. For XEQT, you're looking at financial services, technology, information technology, and healthcare. And lastly, for HGRO, other than ETFs, we are looking at technology, healthcare, and consumer services. In terms of the geographic exposure, for VEQT, your biggest exposure is to US by about 44%, then about 37% to exposure to Canada, and the rest is for the rest of the world, and it's very diversified. You're getting exposure to international as well as emerging markets. For XEQT, your biggest exposure, somewhat similar, about 46% exposure to US, then the next biggest exposure is to other internationals, and lastly is to Canada by about 25%. As for HGRO, your biggest exposure here is to US. In fact, the largest exposure compared to the 3 of them, with about 55%, followed by international, other, Canada, 16%, and Europe about 6.8%. Keep in mind that for VEQT as well as XEQT, although Europe is not indicated, you do get exposure to Europe. It's just built in as part of the other category. Now, I just want to remind you that all these 3 ETF funds are great options for investors who are looking for passive investment options and avenues without having to do stock picking or doing a lot of research. I really cannot pick one over the other in a sense that one is necessarily better. I think all of them are great options. It really boils down to your preference, whether you want to get more exposure to potentially US stocks. Then in that case, HGRO might be a better choice for you because you're getting a higher percentage exposure, around 55% there to the US. If you are interested, for instance, in getting the lowest fee, again, HGRO might be your pick. If you're invested in a fund that has been around the longest, Vanguard is a great option. You know, Vanguard has high quality ETFs. It's a reputable business that I personally have chosen, even though it has a slightly higher fee. I've opted to go with Vanguard product. In fact, VEQT is the choice that I have as part of my portfolio for Smith Maneuver. You're noticing here we do have 2,372 shares of VEQT. It is currently down by about 11.9 or 12%. It in total is down by close to $10,000. Today it was up, as you noticed, it was up by 1%, or because of the shares that we had, it was up by 782. We are trying to gradually buy more shares of VEQT. Unfortunately, because this is connected to our mortgage account, and as we pay down our mortgage, the funds then are becoming available. That's why we cannot buy much more aggressively. Otherwise, times like this, we believe it's perfect time to dollar cost average and buy more shares of VEQT. We still have, I think, about $100 left in this account. So most likely over the next span of the next few days, we will be adding to these existing shares. And as more funds become available, we want to dollar cost average and buy more and more shares of VEQT. That's really our major pick in our Smith Maneuver portfolio. Let me know if you are invested in any all-in-one exchange traded funds. As always, if you enjoyed this video and gained something of value from it, please don't forget to smash that like button and subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing, whether it's investing in stock market, dividend stocks, growth stock, and penny stocks, as well as passive investment through ETFs. Thank you very much, and I hope to see you all next time.